Crypto Trading for Beginners, a beginner's guide to cryptocurrency trading. Key takeaways: cryptocurrency trading involves buying and selling digital assets with the goal of making a profit. To trade crypto, you'll need to choose a reliable exchange, create an account, and understand key trading concepts like trading pairs and order types. Common trading strategies include day trading, swing trading, scalping, and long-term investing. HOD link. Traders use technical and fundamental analysis to guide their decisions. Managing risk through proper planning and diversification is essential to long-term success. Introduction: cryptocurrency has attracted millions of traders and investors worldwide, from casual investors to financial institutions. But for beginners, the terminology, strategies, and fast-moving markets can be daunting. Are you considering your first purchase or simply curious to learn more? This guide will walk you through the fundamentals of cryptocurrency trading, including how to get started, the basic terminology, different types of trading strategies, and how to manage risk. What is cryptocurrency trading? Cryptocurrency trading refers to buying and selling digital assets on exchanges for the purpose of making a profit. Unlike traditional markets, crypto markets operate 24/7, giving traders more flexibility but also exposing them to constant price changes. There are thousands of cryptocurrencies out there, but there is a good chance you have heard of some of the most popular ones, such as Bitcoin and Ethereum. In fact, these are the names of the blockchain networks. The tradable crypto assets are called Bitcoin, BTC, and Ether, ETH. How it works: crypto traders can go long, buying an asset expecting its value to rise, or short, selling an asset expecting its price to drop. Some traders hold assets for longer periods, while others prefer to move in and out of positions quickly, depending on their strategy and risk tolerance. More on these strategies soon. You can trade cryptocurrencies against fiat currencies, such as USD, EUR, ETC, or against other cryptocurrencies. The assets you choose and the exchange you use will affect your trading experience. Before trading cryptocurrency: 1. Learn the basics before diving into cryptocurrency trading. It's important to take some time to learn the basics. Binance Academy's trading articles and educational courses are a good place to start. 2. Choose a crypto exchange. Choose a reliable and secure cryptocurrency exchange. Ideally, it should have a proven track record, excellent reputation, strong security protocols, and responsive customer support. If Binance is available in your region, you are off to a great start. For newcomers, beginning with a centralized exchange is recommended. As you gain more experience in crypto trading, you can explore decentralized exchanges, DEXs, at a later stage. 3. Create your account. Once you've chosen an exchange, the next step is to create your account. This usually involves providing your email, setting a password, and agreeing to terms. Exchanges often require identity verification, KYC, to ensure security and comply with regulations. You would need to submit a government-issued ID, proof of residence, and any other documents to complete setting up your account. How to start trading cryptocurrency? Number 1. Fund your trading account. After you create an account, you can deposit fiat currency into your account. Most centralized exchanges allow users to deposit fiat via bank transfers, bank wires, or other common methods, depending on the platform and location. You may also be able to buy crypto using a credit card. If you happen to own some crypto already, you can deposit it into your exchange account. Remember to always send your coins to the associated address. Send Bitcoin to your Bitcoin address, Ether to your Ethereum address, and so on. Sending crypto to the wrong addresses may result in permanent losses. Number 2. Choose a trading pair. Cryptocurrencies are traded in pairs, e.g., BTC USDT, ETH, BTC. A trading pair tells you which assets are being exchanged. For example, in the BTC USDT pair, you are trading Bitcoin against Tether, a stable coin pegged to the US dollar. Crypto to fiat trading pairs involve a cryptocurrency and a traditional fiat currency, such as the BTC EUR trading pair. If the current value of 1 BTC is 92,175 euros, the BTC EUR trading pair chart will show the same value as the market price. In other words, you need 92,175 euros to buy 1 BTC, half of that to buy 0.5 BTC, and so on. Note that you can buy as little as 5 euros worth of Bitcoin. Crypto to crypto trading pairs involve two different cryptocurrencies, such as the ETH, BTC trading pair. At the time of writing, Ether, ETH, is being traded at 0.02285 BTC per unit of ETH. Number 3. Check the order book. An order book is a real-time, dynamic list of buy and sell orders placed by traders. It provides a snapshot of the supply and demand for a specific asset at different price levels. Buy orders, bids, list the orders from traders who want to buy. Organized from the highest bid price to the lowest. Sell orders, asks, display the orders from traders who want to sell, organized from the lowest ask price to the highest. Number 4. Choose your order type. Market order. A market order is the simplest type of order, in which you buy or sell immediately at the best available price. It's the fastest way to buy or sell when you don't want to wait. Let's say the current highest bid, buy order, for 1 Bitcoin is $100,000, while the lowest ask, sell order, is $100,100. If you place a market order to buy BTC, your order will be matched with the lowest ask, which is $100,100. If you place a market order to sell BTC, your order will be matched with the highest bid at $100,000. Limit order. A limit order is an order to buy or sell at a specific price or better. It's a slower way to buy or sell but allows you to set the exact price you want. For example, if Bitcoin is trading for $100,000 but you want to buy it for $98,000 or less, you can set a buy limit order at $98,000. If the price drops to $98,000 or less, your limit order will, likely, be executed, and you'll purchase Bitcoin at the desired price. But if the price never drops to your limit price, your order won't be executed. Number 5. Develop your trading strategy. Think about your trading style and strategy. Every trader is unique, so it's usually better to create your own trading system and improve it as you go rather than copying other traders. This will help you improve and hopefully achieve a more consistent trading performance in the long term. Regardless of the chosen strategy, it's important to manage risk and learn from your mistakes. A trading journal that tracks your trades, including your thought process and decisions, can be incredibly helpful. Popular trading strategies. There are many crypto trading strategies that you can employ, each with its own set of risks and benefits. Let's go through some of the most popular trading approaches. Day trading. Day trading is a strategy that involves entering and exiting positions within the same day. In day trading, you'll often rely on technical analysis to determine which assets to trade. This trading style can be profitable, but it's challenging and definitely not for everyone. Day trading tends to be more stressful and time-consuming than swing trading or long-term HODling. So it's generally not recommended for beginners. Swing trading. In swing trading, you're still trying to profit off market trends. But the time horizon is longer. Positions are typically held anywhere from a couple of days to a couple of months. Swing trading tends to be a more beginner-friendly strategy, mainly because it doesn't come with the stress and time-consuming pace of day trading. Scalping. Of all of the trading strategies discussed so far, scalping takes place across the smallest time frames. Scalpers attempt to game small fluctuations in price, often entering and exiting positions within minutes, or even seconds. As a form of day trading, scalping is also not recommended for beginners. In most cases, they'll use technical analysis to try and predict price movements and exploit bid-ask spreads or other inefficiencies to make a profit. Due to the short time frames, scalping usually has thin profit margins. Scalpers generally trade bigger volumes or dozens of trades to gradually achieve sizable profits. HODling. While not exactly an active trading strategy, long-term investors, also known as HODLers, aim to benefit from the overall growth of the cryptocurrency market. They buy and hold cryptocurrencies for an extended period, often months or years. As a buy and forget strategy, HODling is among the least stressful options. It's ideal for those who believe in the long-term potential of specific assets and are willing to weather short-term price fluctuations. While this strategy requires patience, it can provide substantial returns over time, especially for Bitcoin holders. Technical analysis. Technical analysis is the art of interpreting price charts, recognizing patterns, and harnessing indicators to anticipate potential price movements. Candlestick charts. A candlestick chart is a graphical representation of the price of an asset for a given time frame. It's made up of candlesticks, each representing the same amount of time. For example, a 1-hour chart shows candlesticks that each represent a period of 1 hour. A 1-day chart shows candlesticks that each represent a period of 1 day, and so on. A candlestick is made up of 4 data points: the open, high, low, and close, also referred to as the OHLC values. The open, 1, and close, 4, are the first and last recorded prices for the given time frame, while the high, 2, and low, 3, are the highest and lowest recorded prices, respectively. Support and resistance levels. Support means a level where the price finds a floor, an area of significant demand where buyers tend to step in and push the price up. Resistance means a level where the price finds a ceiling, an area of significant supply where sellers tend to step in and push the price down. Technical analysis indicators. Traders rely on technical indicators to better understand an asset's price movements. These tools help reveal patterns and highlight possible opportunities to enter or exit trades based on current market conditions. Popular examples of technical analysis indicators include trend lines, moving averages, Bollinger Bands, Ichimoku clouds, and Fibonacci retracement, which can also suggest potential support and resistance levels. Fundamental analysis, FA. Fundamental analysis is a method used by investors and traders to determine the intrinsic value of an asset or business. In crypto trading, it often involves investigating the technology, team, adoption potential, and overall viability of a project. In crypto trading, fundamental analysis, FA, evaluates the value of a cryptocurrency by analyzing its technology, use case, development team, tokenomics, and adoption. In crypto trading, FA might also include things like on-chain data, e.g., number of active addresses, transaction volume, etc., project roadmaps and news. Community and developer activity, risk management in cryptocurrency trading. Risk management refers to identifying the financial risks involved with your investments and minimizing them as much as possible. Let's take a look at a few popular strategies. Number 1. Limit your losses. Make sure you don't trade more than you can afford to lose. Use advance order types to lock in profits or protect yourself from losses. For instance, stop-loss orders allow traders to limit losses when a trade goes wrong. Take profit orders ensure that you lock in profits when a trade goes well. Number 2. Have an exit strategy. It's always a good idea to plan for the worst. So, having an exit strategy is an essential way to manage your risks. It's easy to get caught up in a bull market and its euphoria. But having a plan to exit your position can help lock in gains or prevent big losses in case things go bad. One way is to use limit orders to take profit or place a flow on maximum loss that you can stand. As a general rule of thumb, once you have your exit plan, you should stick to it. Plan your trade and trade your plan. Number 3. Diversification. Diversifying your portfolio is one way to reduce your overall risk. You can hold a variety of different assets. Keep each position at an appropriate size, and constantly rebalance the portfolio, so you won't be too heavily invested in any one asset. This can minimize the chance of oversized losses. Number 4. Hedging. Although this requires a bit more experience, you can consider hedging your open positions. Which means taking a position in a related asset that is expected to move in the opposite direction of the primary position. The purpose is to offset potential losses. For example, if you own $10,000 worth of Bitcoin and want to hedge against a possible decrease in its price, you could buy a put option for a premium that gives you the right to sell your BTC at $100,000 a few weeks from now. If Bitcoin's price falls to $80,000, you can exercise your option and sell for $100,000, significantly reducing your losses. If the price doesn't fall, you only lose the premium paid while still profiting from the uptrend of your long position. Closing thoughts. Markets can be unpredictable, and cryptocurrency markets are particularly volatile. With continued learning, however, you should be able to become a better crypto trader. Remember to prioritize risk management in your trading journey. Stay informed about the latest developments in the crypto space, continue refining your skills, and adapt your strategies as needed. Further reading. What is swing trading in crypto? Crypto day trading versus HOD Ling. Which strategy is best for you? A beginner's guide to candlestick charts. Exit strategies for traders. Disclaimer. This content is presented to you on an as-is basis for general information and educational purposes only, without representation or warranty of any kind. It should not be construed as financial, legal or other professional advice. Nor is it intended to recommend the purchase of any specific product or service. You should seek your own advice from appropriate professional advisors. Products mentioned in this article may not be available in your region, where the article is contributed by a third-party contributor. Please note that those views expressed belong to the third-party contributor, and do not necessarily reflect those of Binance Academy. Please read our full disclaimer for further details. Digital asset prices can be volatile. The value of your investment may go down or up and you may not get back the amount invested. You are solely responsible for your investment decisions and Binance Academy is not liable for any losses you may incur. This material should not be construed as financial, legal, or other professional advice. For more information, see our terms of use and risk warning.